Welcome everyone to today's webinar. We've got a pleasure to have Russell Chesler, the Head of Investments for VanEck, Damon Gossam, Director of Business Development for VanEck, and my name is Niv Dagan. I'm the Executive Director of Peak Asset Management. Peak Asset Management, we're a boutique investment management corporate advisory business, Melbourne-based. Our whole model is based on co-investment. And what we are seeing in today's environment is huge inflows of money going into ethical investing funds. And today we've got Damon and Russell giving us a really strong insight in terms of what they are seeing from ETFs. And for those at home that don't know what an ETF stands for, it's Exchange-Strated Fund. It's essentially a listed security that's traded on the ASX that has a number essentially of qualities. And today we'll cover a broad range of background. From a peak investment management, what we are seeing is not only obviously a push for global governments to move to zero carbon emissions, but we're seeing a huge amount of inflows in specific spaces and specific sectors of the economy. Not only the circular economy, which is waste to energy, or companies like an analyse that essentially use industrial waste converting to a fibre to make clothes out of it, but also lithium-ion batteries and cells, companies like Volt, Vulcan, and NMT, which is essentially disrupting the whole supply chain management of batteries. We're seeing a lot of money come through across the board, and we are joined by some experts today. So we're really excited from the Peak Asset Management side to be teaming up with the guys from VanEck. So with that introduction, I just want to introduce you to Damon, who will give a bit of background on VanEck and who they are, and probably ask a few questions.
Terrific. Thanks for having us, Niv. We're really excited to be here today to introduce your listeners to VanEck if they don't know us already, and talk through this really exciting space of both ESG but ETFs as well. So VanEck, we're a US headquartered investment management firm. We were founded in 1955, and we manage around $110 billion globally, across a variety of both active and passive strategies, but also across equities and bonds. So we're a multi-asset group doing active and passive management. On the ETF side of the business, which is certainly the real growth engine of the business, we have over 100 ETFs across all the major global exchanges. On ASX, we now have 29. The first of these, actually, I think it was happy birthday to the first 4 listings a couple of days ago. They turned 8 years old, but the 29 ASX listed ETFs are really designed to provide investors with access to beyond the normal approaches to established investment categories. So, like ESG investing is a great example of that. So, listeners will be aware that ETFs are generally index-based funds, and they'll be aware of, say, the S&P ASX 200 or the S&P 500. But being able to actually put an ESG, a true to label sustainable strategy in a passive vehicle, that's what we mean by beyond the normal approaches. The other part of the business is real new opportunities. So asset classes we're really positive on, but that most investors don't have exposure to. That could be things as targeted as clean energy, could be China, could be emerging market debt, a range of different things. So that's a bit about us. We're the 4th largest ETF in the Australian ETF provider in the Australian market. We're the fastest growing, and this is such an exciting space to be in. So it's great to talk to you today.
Damon, I just want to start with a really simple question. But what are ETFs, and why are they beneficial?
Yeah, well, you gave a really simple and effective definition right at the start. So ETFs are a really efficient, low-cost way of investing in stocks, bonds, or other assets. So to break it down, ETF stands for Exchange-Traded Fund. The Exchange-Traded piece means you can trade an ETF in the same way you would trade a share, i.e. you can buy it or sell it on a stock exchange. The fund component means effectively it's a basket of securities. So it's a way of investors getting instant diversification across a range of underlying companies or bonds or commodities or other types of assets. So the first ETF listed in 1993. Now there's more than $8 trillion in ETFs globally. We punched through the $100 billion mark in the Aussie market through this year, and it's growing at a phenomenal rate here. So ETFs are certainly not only the fastest growing sector in asset management globally, but Australia has certainly followed that trend as well. And the reason for that popularity and why they're so beneficial to investors is, like I said, it's a diversification with a single trade. So quite often you could pick up dozens, if not hundreds, of securities in one investment vehicle. You can buy and sell on exchange. There's market maker support to actually provide that liquidity for investors to get in and out of. They're generally speaking very low cost. So I know when we benchmark ourselves against comparable, say, active strategies, we're typically a third or a quarter of the management cost there. Access to markets that are hard to get into. So take international securities, or go a step further to mainland China stocks, where you may need a quota. We have a quota to actually buy those types of securities. There's tax advantages, and finally, transparency is one major one. And I think on the topic of ESG, where people want to understand what sits under the hood, the fact that an investor can jump on our website and see every single holding of all of our ETFs every single day, that's just another great benefit for the end investor.
And Damien, you touched on it. I mean, $8 trillion in ETFs, that's absolutely huge. So why did VanEck specifically are you pushing and made you so, call it pro, the ESG space?
Well, I think, and Russell will be able to provide some comments here, but from our perspective as well, it's like clearly there is a huge movement towards ESG investing globally. So there's the demand aspect of it. But there's also a real growing body of evidence that suggests that investing sustainably, and so investing in, say, the ESG leaders is a way of actually adding value to client portfolios as well. There's a whole range of, I guess, positive financial metrics, whether it be in terms of profitability or risk metrics around stocks as well, for those that have that ESG that are the ESG leaders. So Russell might have some thoughts on this one that he'd like to share as well.
Yeah, no, thanks for having me on today. Great to be here. I think, I'd like to take a little bit of a step back, and if we look at the history and growth of ESG, sustainable investing has been around for centuries. Really, a good example is the Methodists and Quakers back in the 18th and 19th centuries. They were firmly opposed to slave trade, and they imposed screens on investments, tobacco, gambling, alcohol, all those things that were considered bad at the time. But it hasn't become mainstream until recently. If we look at the term ESG, that term was first coined in 2005 in a landmark paper, which was titled "Who Cares Wins?" And I think it really goes to what Damon says, what that paper was really saying. It was looking at sustainable investment from a different perspective. Previously to that, you were doing it for moral and ethical reasons. But like the title says, investors can win by investing in sustainable companies. So they're not just doing the right ethical and moral side of things, but you can get the right investment outcome. In 2006, we saw the UN Principles for Responsible Investing were formulated, and this really started to drive the whole ESG movement. Now at VanEck, we're a signatory to the UN PRI, and our US business first launched a green bond ETF in the US in 2017. That was the first green bond ETF. So really from a firm perspective, we really believe in ESG as well as in the likes of clean energy. At the same time, in 2017, we were working on our international ESG ETF, ESGI, which we'll, I'm sure, have an opportunity to talk about a little bit later. And at this stage, really, in the last 4 or 5 years, we've seen ESG really go mainstream, and we've seen that market grow dramatically. If we look at the size of the market, that retail size of the market, I guess in Australia, is about 33 billion invested. That's increased by 66% from a year ago. And just in the last quarter, we had the biggest inflows into ESG funds of around 3 billion. So it's certainly an area that's taking off.
And Russell, a question for you. How does VanEck construct a lot of the ETFs? I mean, what criteria do you look for? And what is the investment process?
So I think if we look generally, when we're constructing an ETF, we look at two. We want to look at two key areas. Firstly, we want to make sure that it is backed by academic research, and whatever we put out into the market, we want to make sure it's true to label, and that it will perform as expected and do what investors expect at the end of the day. So, like with all our ETFs, we consider all the capabilities of all the index providers in the market. And when it came to ESG, we chose to work with MSCI due to their really strong capabilities in the ESG space. MSCI has a highly awarded ESG business. It's got over 350 staff and 200 ESG analysts, and all they spend their time on is assessing companies for their ESG credentials. What they do is they rate each company on 37 different issues under the 3 pillars of E, S, and G, so that's environmental, social, and governance, and produce an overall rating for each company, ranging from AAA for the best down to CCC for the laggards, similar to the way in which bonds are rated. Now, if we look at our ESG ETFs, we wanted them to really be true to label, and to achieve this, we've decided they should be dark green, so they should be really ESG at the end of the day. Let me explain a little bit by what I mean by dark green. We don't only have a large list of exclusions, which includes fossil fuels, weapons, alcohol, tobacco, gambling, adult entertainment, nuclear, GMO, animal welfare, and soft drinks. You'll agree, quite a long list. But we go a number of steps further. That's just the first part of it. The next step is to exclude companies which have a significant controversy as determined by MSCI. Now, a great example of a controversy was when Volkswagen manipulated the measurement of nitrogen oxide emissions from its cars. I'm sure something everybody remembers and was really surprised by. But by the way, Volkswagen was already poorly rated by MSCI at the time and was not in the index. So having somebody like MSCI to catch those things before they become a controversy is really important. Once we've removed all the controversies, we've now got a set of companies left, and from those we select those which have the highest ESG scores. So that we select those which are really at the top of the MSCI range. Once we've got those companies, there is still an additional step. Out of those companies remaining, we remove those with the highest carbon emissions. So Niv, I'm sure you'll agree that this is a dark green, that the way we're going about it is the dark green side of things.
Very, very interesting in terms of the criterion, the example you gave with Volkswagen, and obviously also Mobil Axon when they had a huge oil spill. I suspect that that would have changed a lot of the criteria. I wanted to dig deeper. Can you tell us, and this is just a question for you, Russell, and also Damon, what are the types of ETFs that you're seeing? What are the most popular ETFs, especially on the ESG side?
In terms of the ETFs that we offer on the ESG side, we offer an international ETF, which is called ESGI. And on the local side, we offer one which is called Green V, and that's GRNV, and that covers Australian equities. Also, we've also got a clean energy ETF, CLNE, and that's been growing rapidly. It was only launched in March and it's attracted over $80 million. And that not only looks at clean energy, but it also does have ESG screens within it to make sure that those renewable companies, they might be satisfying the E, but we want to make sure that they're satisfying the S, the social part, and the governance part of it. But I'm sure Damon's got some more to add to that.
Yeah, so I think there's the two broad cohorts and probably two broad categories of funds, and so like Russell said, we've got 3 ESG funds. 2 are very broad-based, so the broad global equities, ESGI, and broad Aussie equities, GRNV. Effectively, they're designed to be effectively whole of asset class solutions. So if you're wanting to, if an investor was going to have 30% in Aussie equities and really wanted a true to label, was a big believer in ESG, that's exactly what GRNV is designed to occupy. It's broadly diversified with ESG leaders and and a very tight range of negative screens as well. And those types of strategies seem to be, they're very popular with individual investors. They're very popular with, and we did a lot of consultation with advisors that deal with, say, not-for-profits, charities, where they've actually embedded in their actual investment doctrines an ESG overlay. So they're kind of institutional grade types of broad exposures. On the other side, and the clean energy fund that Russell said has had a great reception here since we listed it, CLNE, the VanEck Global Clean Energy ETF. Yes, that derives a lot of interest from people that are really interested and engaged and huge believers of ESG investing. Nonetheless, it's undeniable that there is a huge transition underway from non-renewables to renewables in the energy spectrum. And so that ETF is designed to be able to help investors express that view. If they're wanting to invest in the energy of the future being a whole range of different renewable types of sectors, that's what CLNE captures. So it's more of it's somewhat of a thematic strategy, but a really long-term structural trend that we believe in.
Gents, I've got a few questions from the audience that have just come through. So more broadly speaking, we're seeing a lot of talk about inflation, uncertainty, global markets. Things are opening up post the COVID-led recovery. So 2022 is an interesting time for global markets. We also agree. What are you seeing in terms of from an ETF? Is there a way that investors essentially hedge their portfolio using exchange-traded funds?
I might have a go at this one, Russell. Absolutely, and I think the main advantage of using an ETF compared to individual stocks is the diversification, which admittedly I understand that sometimes sounds like a bit of a motherhood statement, but in reality there's plenty of reasons for investors to actually be on guard given the world we're actually in, given the unconventional interest rate and fiscal policies globally, and the fact that up until a week or two ago we were hitting all-time highs with markets. And so one way of reducing that risk is to be really well diversified. And like I said at the start, ETFs often provide dozens, if not hundreds, of underlying stocks to do that. In terms of that particular component of the question about the uncertainty and the talk about inflation, we see ETFs as a way to express a view. For instance, if an investor wants to position for an inflationary environment, ETFs provide the tools to do that. For instance, so we've got 29 ETFs. We've got plenty of different vehicles there. But of late, there's been big take-up of certain ETFs that could do well and should do well in an inflationary environment. For instance, we've seen this gravitation. There's a lot of talk about a value rotation, and so our global value fund VLUE has been one that's been shining of late. A lot of interest in gold and gold equities. Our flagship fund globally is GDX, the Gold Miners ETF. Another hedge would be infrastructure and property, and so funds in that infrastructure space and property space have been very popular. And then it's not limited just to growth assets and to equities. We've got floating rate exposures, i.e. funds that aren't taking any interest rate risk. We've got 3 bond strategies that are not exposed to that interest rate risk. And so increases in rates as and when that happens is actually a tailwind for those types of funds. So that absolutely an ETF is a perfect vehicle to get that type of exposure.
And Russell, what are your views on that?
Well, I think Damon's covered a lot of options there, and it really, as he said, we're giving investors a range of different ways to express a view or take a view on where they necessarily see markets going. So they've got a lot of tools they can use within our 29 ETFs that we have on the market.
And just on another point, that's another question that's just come through the audience. If I'm an investor and I want to find out the type of ETFs, what stocks make up and the composition, the charges, the returns over the last 12, 18, 24 months, how do I do that?
I can answer that. I mean, that's very easy. If you want to find that out on one of our ETFs, just go to our website, and all that information is sitting there. Size of the funds, the full portfolios on there. You can download it into an Excel spreadsheet on a daily basis. You can see it. It's transparent, and it's completely up to date. The returns are on there. There's lots of other information as well on the website. There's fact sheets, there's videos, there's blogs as well. So lots of information to assist investors to educate themselves as well.
I might just chime in if I can as well, just because we've been talking extensively about ESG investing. We even go a step further with the ESG funds. We provide a sustainability impact report for each of the ESG funds there. So an investor can actually see, a big part of our process is the positive screening, the best performance from an ESG perspective, and can go, what difference does this screening process make? And so I know that the most recent fact sheet in this regard shows that ESG leaders, so AAA and AA rated companies from an ESG perspective, make up 90% of our ESGI. That compares to less than 30% in the broad MSCI World ex Australia Index. We can actually see the actual carbon, like we even report on look-through carbon emissions, and so the tons of carbon dioxide per $1 million invested on that global equities ESGI is 8 tons, which is 1/10 that of the MSCI World ex Australia. So there is just so much information. Being an investment vehicle, being an ETF provider, where we pride ourselves on the transparency, we can showcase all of this for investors.
That's quite outstanding. The fact that you can actually generate those reports, Damon and Russell, that's very, very good in terms of transparency. I do have one more question that's come from the audience. So, and this is probably directed more to you, Damon. How can I add exchange-traded funds in my investment portfolio?
Well, fortunately for us, with great ease in that they're bought and sold just like any listed security, any share. So we are big advocates of advice. So we see a lot of trading come through from financial advisors and stockbrokers. But just the same, there's a lot of individual investors where all they need is an online broking account, and just as they go and buy BHP or CSL, they can invest in an ETF. What I would really urge anyone to do, beyond actually really understanding the ETF strategy itself and what sits under the hood, we've got a lot of educational tools on our website, which talks through some of the best practice execution sorts of tips. We encourage people to not trade in the first or last 15 minutes of the day. When markets are closed, if it's an offshore ETF, for instance, if it holds a lot of Asian equities, most of those countries trade during our ASX day, but not until a couple of hours in. And so from a best pricing perspective or fairest pricing perspective, that's when it's there. So there are a few tips and traps, and we've got documentation on the website to go through it. And likewise, we've got an investor hotline for anyone to ask any questions.
Just on that point, I think just before we conclude, because I know we're running out of time, but the 15-minute side on either side, the open and the close, is that because of liquidity and the ETFs can be illiquid or can gap up and down? I mean, what's the main reason for that, Damon?
It would be remiss of me to explain it when I've got my head of investments handy here. So Russell,
Sure. So the market opens up in alphabetical order. So when the market opens in the morning at 10 o'clock, not all the stocks are open, which means that the market makers who are making a price on the ETFs can't accurately price them. So the spreads tend to be quite wide. So you're not going to get the best pricing. And at the end of the day, what Damon's referring to is the markets close at 4 o'clock, but then go into auction. never leave anything there to the auction, because again, it's the same situation. Only when the auction's finished can you really price underlying shares, and that's too late basically for the market makers. So they're going to add in an extra spread. You're going to be paying more. The other point we'd always say is always use limit orders and not market orders, because at a point orders could be pulled out, or you might actually buy down into a lower level and land up paying a higher amount for the stock than you would have anyway.
Damon, Russell, it's been absolutely fantastic. It's such great insight about VanEck, and obviously on the ESG side, and we at Peak are big supporters. So thanks very much for your time, and hopefully we'll see you soon.
Terrific. Thanks so much, Niv.
Thanks for having us.
Thanks, guys.